Welcome back. If you follow the financial news at the moment, things can feel pretty uncertain. There's lots of worried voices out there. They're worried about debt, inflation, interest rates, you name it. And of course, that makes it very hard to know what you should listen to and what you should completely ignore. So in this video, I'm going to go over the main macro indicators that I look at and what effect they can have on the markets. Just as a reminder, this is not financial advice. I'm not a financial advisor. I'm just simply sharing what I do in my investment journey in the hope that it'll also help you in your investment journey. So why are monitoring those macro indicators important? Well, you can imagine trying to drive a car without a dashboard, no speedometer, no fuel gauge, no temperature warning light. You'd be flying blind, or in this case, of course, driving blind. These metrics provide a vital sign of the economy's health and offer a insight, a clue into their future direction. You might also think of them as the pulse or the blood pressure of the economy. It gives you a snapshot into the overall health and vitality of the economy. And by tracking these indicators and others, it can give you, to a greater or lesser degree, a greater understanding of perhaps the anticipated market trends. You can spot opportunities potentially and risks before maybe the headlines show them. It can allow you to stay informed about your investment decisions, make sure your portfolio is aligned with the prevailing economic winds. It may also allow you to understand market sentiment a bit better, perhaps gauge investor confidence and gauge potential shifts in market behavior. So what are the metrics that I tend to keep an eye on? Firstly, gross domestic product. It measures the overall economic activity for a country. It's like the economy's overall annual report card. It's updated on a regular basis and often revisited months later also. Second one is inflation. It tracks the rate at which prices for goods and services are rising. Often it's seen as that silent thief that erodes your purchasing power, but it helps in hidden ways, and I'll come on to those. Then you've got interest rates, which are set by the central bank. These influence borrowing costs and often investment decisions. They're like a volume knob of the economy, controlling the flow of money. Then an interesting one, and it's often a leading indicator, it's the Purchasing Managers Index. This provides a snapshot of business activity in the manufacturing and also the services sector, which is critically important to the UK at the moment. It's almost your crystal ball, potentially offering a glimpse into future economic activity. And employment is an indicator. Various countries will look at this differently, but it offers an insight into the health of the labour market and consequently consumer spending. And of course, consumer spending is a foundation of a strong economy. More people working, more people earning, more people spending. And there's government debt, obviously a hot topic at the moment. It reflects the country's borrowing levels and has a potential impact on economic growth. It's almost a financial baggage that the country carries. It can weigh it down if it gets too heavy, and it has a considerable impact on market confidence and the bond markets. So that's the indicators that I'm interested in. Now there's many others, of course, like yield curve, commodity prices. They are often leading indicators too, but the ones above are the ones that I tend to keep a closer eye on. So let's take a deeper dive into each of them, starting with gross domestic product. So GDP, like I said, is like the economy's report card. It tells us the total value of goods and services produced within the border. A rising GDP generally signals a healthy economy. It boosts investors' confidence and potentially leads to higher stock prices. Conversely, a declining GDP can raise real concerns. Often at this time, recession is mentioned, which is 2 consecutive quarters of negative GDP. And a decline in GDP can negatively affect market sentiment. I'll give an example. In 2023, UK's annual GDP growth was a very modest 0.4%. Now the forecast for 2025 by OECD is predicting 1.7%, PwC predicting 1%. Now this discrepancy highlights the uncertainty of economic forecasting and the importance of considering more than one source. The GDP of the UK has been a concern for some time now. The productivity of the country has been something that has been lagging some other major Western economies. More broadly, in times of real market concerns, you can see very large GDP declines. For instance, during the Great Depression, there was a catastrophic decline in GDP, with the US GDP falling nearly 30% between 1929 and 1933. Let's move on to inflation. Inflation, as we said, is that silent thief. It erodes your purchasing power. High inflation can create real uncertainty. It impacts corporate profits and leads investors to seek inflation-hedged assets like commodities, real estate, for instance. One example of how this can impact the markets is companies often struggle to pass those increased costs onto consumers due to affordability reasons. That leads to reduced profit margins and potentially lower stock prices. So a simple way to think about inflation, it's related to your daily coffee at your local coffee shop. If that price increased at a certain point in time, you would stop going for that coffee, or indeed you make a home brew. That would lead to less economic activity in the market, less people serving you, less costs and less profits to that company. Inflation has been a concern across the globe, but in the UK it's been a major concern. But interestingly, the average inflation rate between 1950 and 1988 was around 5.8%, considerably higher than the 2.6 average between 89 and April 2022. Now, forecasts suggest inflation is expected to fall to about 2%. If this forecast is true, and remember, inflation is struggling to come down at the moment, it's remaining particularly stubborn in the UK, then we'll return to a more predictable economic environment. Now, we've talked about the dark side of inflation, but it does have some good outcomes. We can reduce the real value of debt so that the real value of the debt outstanding decreases over time as prices rise. And that means that governments can repay their debts with essentially cheaper money. It also increases nominal GDP. So inflation can lead to higher nominal GDP unadjusted for inflation. This then, of course, makes the debt to GDP ratio, which is an important measure of the country's debt sustainability, look much better. It can also boost tax revenues. Inflation can lead to higher tax revenues as incomes and prices rise, and this provides governments with more resources to service its what looks like ever-growing debt. Let's move on to interest rates. They can be compared, as I said, to the volume knob for the economy. Central banks use them to fine-tune economic activity. So the higher interest rates they increase borrowing costs, they potentially impact corporate profitability and stock valuations and therefore the markets. So when you increase the cost of borrowing for business, it can lead to reduced investment, and usually that would mean slower growth. Conversely, lower rates can stimulate growth and make equities more attractive. For example, a lower interest environment such as we saw in 2010s, it encouraged a lot of companies to borrow more, which led to economic growth. In the UK, as we know, the Bank of England has been raising interest rates to combat that high inflation. The bank rate rose from 0.1% in early 2022 to 5.4% just over a year later. Now, interest rates are currently sitting at 4.75% at the end of 2024, but it's proving, because of that stubborn inflation, to be hard to reduce those rates, which we know that the Bank of England is looking to do once the economic indicators and the environment is right. And not surprisingly, higher interest rates also make newly issued bonds more attractive to investors, of course then give a higher return. So this often leads to a decrease in price of existing bonds. Now, I've created a video that covers cash type and bond type investments, also the impact of inflation, interest rates and the market conditions on those types of assets. And you can see that above. Let's move on to one of the indexes that I found interesting, the Purchasing Managers Index. PMI, it's a forward-looking survey. It surveys business activity in the manufacturing and service sectors. Remembering the service sectors are very important to the UK. PMI score of over 50 indicates expansion, while under 50 indicates contraction. And that 50 mark is crucial because it represents that dividing line between expansion and contraction. A consistent reading above 50 suggests healthy growing economy, while below that is suggested a contracting economy. Now, traders use PMI data to anticipate market movement. Like I say, it's like a survey of market leaders to assess their optimism or pessimism about the future. The PMI assessment is relatively universal, certainly available in the US and the UK. And for example, in December 2024, the S&P Global Flash US PMI Composite Output Index rose to 56.6%, signaling the fastest expansion of business activity since March 2022. We'll touch on the Consumer Confidence Index in a minute, but both PMI and the Consumer Confidence Index have shown significant correlation with other economic indicators and ultimately stock market performance. So for instance, the PMI has strong correlation with GDP. PMI is considered a reliable leading indicator of GDP growth. A rising PMI often precedes an increase in GDP and vice versa. There's actually been some research that suggests that the PMI survey data has a higher correlation with equity markets than even GDP data. So for instance, a PMI index in the US, when you then look at the correlation between that and earnings for the S&P 500, it's at 74%, which shows high correlation. The PMI can also have an impact on market sentiment. A strong PMI can boost investor confidence and lead to positive market sentiment, potentially driving stock prices. However, conversely, a weak PMI can trigger concerns about economic slowdown and perhaps negatively impact market performance. On screen, I'm showing the composite PMI for the UK. It is just positive and suggesting an expectation of minor expansion. Here, for comparison, I'm also showing the US composite index, and you can see that the score is running higher. Moving on to employment data, now I'm particularly interested in the unemployment rate and wage growth. These can provide good insight into consumer spending power and economic stability. Strong job market with low unemployment and rising wages can boost consumer spending overall and therefore economic growth. The connection is straightforward. More people earning, working, have more money, more likely to spend, and that can fuel economic activity. For example, in the US, the unemployment rate was 4.1% in December 2024. However, forecasts for the UK suggest that the labour markets may face some challenges in 2025, with employers remaining cautious in their hiring approach. This more cautious approach could be a sign of economic uncertainty, as businesses are a bit more hesitant around expanding their workforce in the face of those potential economic headwinds. Full employment is often seen as something between 4 and 5%, and that means most people who want a job can find one. And so while high employment is often seen as a positive, it can have its downsides, particularly on the impact on inflation. As more people have greater spending power, it can create an increase in the demand for goods and services. And this can of course mean that demand can outpace supply, putting a pressure on prices. There's also the issue about wage inflation. In a tight labour market with high employment, employers often need to offer higher wages to attract and retain workers. This can lead to wage inflation, which can contribute to overall inflation as businesses pass on those increased labour costs to the consumer. Now, there are quite a few tools out there that look at that relationship between inflation and unemployment, but generally, when unemployment is low, inflation tends to rise, and vice versa. So let's move on to government debt. Hot topic for many countries at the moment, but particularly in the UK. Government debt can impact both stock and bond markets. High levels of government debt can crowd out private investment, leading to slower economic growth. And potentially, of course, lower corporate profits, and of course, that impacts the market. It can also impact bond yields and create a lot of uncertainty in the market, which we're seeing in the UK. When a country's debt is manageable, it allows for greater investment potential for companies and usually a more stable outlook, and of course boosts investor confidence therefore. Conversely, if government debt is seen to be out of control, it can have a considerable impact on the bond prices and markets. We've seen this in the UK recently with the long-term gilt prices rising to a high level. Now, often a good way to look at government debt is to look at the ratio between debt and GDP and to assess that debt burden. A higher ratio suggests a greater risk of financial instability, as the government would not be able to fund the debt on an ongoing basis. These indicators are interconnected, as you would imagine, and they do influence each other, of course, and in quite complex ways. So I've tried to simplify that interplay. So if we look at GDP growth and inflation, it often has a positive correlation, means they go up together, but high inflation can eventually dampen GDP growth. It can act as a brake on the economy by reducing consumer spending and business investment. If we then look at inflation and interest rates, central banks raise interest rates to combat inflation, but higher rates can slow down economic growth. So it's a delicate balance to get the right temperature. If we look at interest rates and GDP growth, lower rates can stimulate growth, while higher rates can slow it down, understandably, because lower rates make it cheaper to borrow money, encouraging investment and spending. If we look at GDP and employment, strong GDP often leads to increased employment. A growing economy needs more workers to produce the goods and services that we all use. Now let's look at PMI and GDP growth. A strong PMI index often correlates with positive GDP growth. PMI acts as an early warning system for changes in the GDP. Often. So more broadly, you can think of the different indicators as gears in a machine. They all work together, and a change in one gear affects the outputs and the outcomes of another gear. So let's get to what I tend to look at on an ongoing basis when it comes to those economic indicators. There's no one single indicator or group of indicators that can perfectly predict the market. If there was, then we'd all be very rich. So I tend to look at a number of indicators. One particular leading indicator that's interesting is the PMI, and then a couple of lagging indicators, interest rates, inflation rates, and debt to GDP ratio. Broadly, they're the ones that I tend to look at. The PMI gives an early signal, if you like, of economic turning points. Changes in the indicator can often precede shifts in things like GDP growth, inflation, interest rates. It allows us to anticipate some of those potential movements. And then two of the lagging indicators give us a view on the magnitude of the changes. Inflation and debt to GDP can confirm the trends and indicate the magnitude of those economic shifts. And dependent on the outcomes from those indicators, we can assess the strength and stability of the economy. And then there's, of course, policy response. Monitoring the central bank interest rates helps us understand how policymakers are responding to economic conditions. This can provide clues about the future direction of monetary policy and its potential impact on various asset classes. However, there are weaknesses with just monitoring a few metrics. It's not always consistent. The relationship between these metrics and others and the stock market performance is not perfectly consistent. Like I say, if it was, we'd all be millionaires. Of course, the ones I've chosen have limited scope, but all indicators are limited in their scope. Focusing solely on these indicators, though, you may overlook crucial factors that can impact investment strategies, such as geopolitical events, technological disruptions and changes, and changes in consumer sentiment may not always come through. And one other crucial aspect is time lags. Whilst the PMI and consumer confidence are leading indicators, there can still be a considerable lag between what they recognize and the changes to markets and the economy. So what should we do with all that information, with all those good indicators? Let's say the PMI is getting worse. It could be an indicator of worsening economic conditions. So you might want to take a more defensive approach with your investment strategy. So here's some things you could do. You could assess your time horizons. If you have a long-term investment horizon, you may be able to ride out short-term market fluctuations. However, if you've got a shorter time horizon, you may need to adjust your portfolio to reduce the risk. You also might want to consider your financial goals, ensure that the investment strategy you have aligns with your financial goals. And of course, if this changes your risk tolerance, you can adjust your portfolio accordingly. You may also want to consider diversifying your investments further. Diversifying across multiple asset classes, particularly if they don't correlate, means that you don't have all your eggs in one basket. You could do this across, for instance, stocks, bonds, real estate, commodities. Overall, just to make sure that diversified portfolio is managed for your risk levels. You can also diversify geographically. Consider diversifying your investments such that there's a good geographical spread to reduce exposure to one single country or region. And you also might want to consider rebalancing your portfolio. I've done a video on that, you can see it above, but increasing allocation to defensive positions, defensive stocks or money market funds or cash, that might give you resilience to market slowdowns. And you might also consider changing your allocation and putting it into certain sectors. You may also consider looking at more fixed income investment types like bonds or gilts, or other wealth preservation type investments, money market funds, premium bonds, etc. And then, of course, I'd say keep monitoring the economic indicators as you go forward. Stay informed. Make sure you're looking at the PMI, inflation, interest rate, etc. Just because the PMI suggests that there are certain market conditions coming, that doesn't mean that the magnitude of them are concerning based on the macro lagging indicators that we've talked about. I'd like to leave you with just some final thoughts. Firstly, wherever the economic indicators suggest we might go, we shouldn't panic. Market fluctuations are normal. We should stay focused on long-term goals and remember that investing is more a marathon than a sprint. Secondly, don't spend all your days looking at economic indicators. They can be blown out of proportion by the media. Set a time frame when you're going to look at them, assess them as critically and rationally as you can, and then revisit your risk profile to assess whether those economic indicators would suggest an adaptation to your strategy. Let's wrap up. Thank you for watching. I hope this video has been useful. Remember, please like, subscribe, and hit the notification bell so you'll be told about the next video as it's released. With that said, happy investing and see you next time.